Hello everyone, welcome back to my channel. Today we're going to be covering probably the most complicated business entity, and that is a C corporation. What is a C corporation? A C corporation is a business entity. Filing for a C corporation is not easy. The universal steps are the following. First, you must select a corporate name. This is, up to the forming parties. Then you need to file your articles of incorporation with your Secretary of State. Now, each state is slightly different. In the state of Kentucky, this can be done all online for a small fee. It's $50, I think, in the state of Kentucky. And then in a couple days, they'll mail you a piece of paper basically saying, congrats, you've been incorporated in the state of Kentucky. So from there, you need to create your corporate bylaws. This is typically done by a lawyer. This is in case something goes awry in the business and some party wants to get out for legal reasons or whatever else. This isn't really our area of expertise, but we know it needs to be done. Next, draft a shareholders agreement. It's similar to the corporate bylaws in some ways, but this is more about the income and the expenses and how that stuff's going to be distributed once the corporation really gets up and running. This is more in our area of expertise. Now, maintain corporate minutes. This is one that we see our C Corps and S Corps fail to do on a regular basis. You need to have a shareholders meeting once a year between your main shareholders in your business, and you need to keep at least an idea of what's going on in that shareholders meeting written down or typed up. Okay, this is just in case anything crazy happens and the state, if you have these, then the state, there's no way that they can say that your corporation isn't valid. Okay, then you need to issue the shares of stock. This is typically negotiated in your shareholders agreement. It's based on, what each party contributed whenever the corporation was being formed. It's very individual, but you typically would like the help of an accountant to do it, because if you issue these shares of stocks incorrectly, then your basis and that kind of stuff gets really funky and it can be very complicated. So, the liability and the tax implications. Now, the liability, I'm not a lawyer, I'm an accountant. The tax implications is my area of expertise, but I do know that under a C corporation, your personal assets basically cannot be attacked unless you do this thing called piercing the corporate veil. It is very rare. It basically only happens whenever there is absolute gross negligence involved by the corporation's owners. And I've only ever heard of a couple of cases happening ever, basically. So you don't have to worry about that unless you're just being an absolute fraud or something horrible happens because of your gross negligence. Next, because a C corporation is treated as its own entity and nobody can come after your personal assets, the C corporation is taxed as its own entity. And this is the major negative of a C corporation. There's lots of advantages. I don't have time to go into all of them, but the major negative is that a C corporation is double taxed. This means that, let's say your first year of operations, you make $1 million. Congrats. You have $500,000 of expenses. Okay. Then, so you have $500,000 of taxable income on the bottom line of your 1120, which is the form that you file to do your taxes for your C corporation. That $500,000 is going to get taxed at 21% of that income. Okay. So off the top of my head, I think that's, $105,000 is going to be your tax liability for that $500,000, meaning you'll be left over with $395,000. Let's say you have two corporate forming partners and they split that money evenly. Then once that $395,000 gets split, then on their personal returns, so on their 1040s, that money is going to be taxed again. Okay. So you have a lot more tax liability like this because you have lots of other advantages. One of the main advantages is that you can be put on the public market and sell shares of your company, which gives you way more capital options to continue business than any other forming of entity. Basically, in other entities, you're limited to what you can borrow or your personal assets and for getting capital. With a C corporation, you can sell parts of your business to have capital so that you can continue operations. I know that this was relatively short and I glanced over a lot of it. There's lots of more minute details that just this type of channel isn't going to cover. You really need to go to an accountant or a tax lawyer to know the ins and outs of these types of things for your specific situation and the important aspects of it all. If you have any specific questions, you can reach out to me personally at my business email. As always, it's going to be in the video description. I hope this helps. Thanks.